It's all about you, retail investors. Whoo! Bullshit! Bullshit! You lying, slimy motherfucker. You don't care about retail investors. Stop saying it. Stop. All right, let's talk about a couple of things here. One, why stablecoins are not a security. I repeat, stablecoins are not a security. Two, staking. This whole staking kerfuffle. Gensler is making this, is on this crusade, going after Kraken first, and I'm sure going to go after other exchanges in an attempt to for retail protection. That's just absolutely absurd in its face, and I'll explain to you why. One of those things is fractional reserves, which is something the banking industry has done forever. And if you don't know what fractional reserves are, it's essentially the bank takes your money and they lend it out. They lend it out to other people. Say if somebody goes to the bank and gets a loan, where do you think that money comes from? It comes from you. It comes from your accounts. Where do you think the interest payments come from? It comes from these people paying the interest back on the loan. Now, this is just a rough example. It's a little, it can obviously be a little bit more complicated than that, but just for the sake of argument, simple example. And I'll get into the actual details, meat and potatoes of it in a little bit. So let's just look at first let's talk about the staking. Cracking down. Oh, it's a cute little pun. SEC commissioner, blah blah blah. He shut that down, and he shut it down under the guise of protecting we retail investors, when in actuality there was no harm there. Kraken is one of the more, I don't want to say regulated, but I mean, KYC verification, the whole 9 yards. It's legit, and it's a U.S. company. It's in the U.S. Unlike FTX, which was based out of the Bahamas, out of the SEC's reach, Kraken and Coinbase and Gemini are based in the U.S. And if he keeps doing this shit, they're not going to be for long, and for good reason. So he shut down staking for Kraken. Boom, right? The one SEC chairwoman spoke up. Pierce said Thursday in a statement that she disagreed with her agency's action this week to shut down Kraken's staking program, a move the SEC counted as a win for investors. Pierce's role as commissioner includes advising the SEC on applying rules to new development in financial markets, to new developing financial market, like crypto, which would be a new developing market. For those, if you don't know, staking refers to the process of crypto investors depositing tokens in certain blockchains, and there's different kinds of staking, and you get a yield, you get interest. Essentially, it's like when you deposit money in the bank and you get a set amount of interest back, except when you stake, you get a lot more interest back. I mean, a lot, depending on which token you stake. There's all different yields. Gensler said, whether it's through staking, as a service, lending, or other means, crypto intermediaries, when offering investment contracts in exchange for investors' tokens, need to provide the proper disclosures and safeguards required by our securities laws. So right there, just right there, there was no and is no way for these exchanges to sign up. There is no form for them to fill out. This is a fact. Brian Armstrong of Coinbase. There was no way to register. It's a disingenuous offer. He's quoting, read the direct quote. This is from Heston Pierce, commissioner in the SEC. We have known about crypto staking programs for a long time. Although it may not have made a difference, I should have called for us to put guidance on staking long before now. Instead of taking the path of thinking through staking programs and issuing guidance, we again chose to speak through enforcement and an enforcement action, which is, that's the Smart way to go. It's, what concerned her most was that their solution was to shut down entirely a programmed, quote, that has served people well. This is from a commissioner in the SEC, not Chair Gensler, that corrupt tool bag that looks like a penis. I mean, his head is in the shape of it just looks like he literally looks like a dick. How else can I say it? Yeah, I'm sorry. Let's actually watch his little, where is it?
In the crypto,
he's got these little cute videos. They're so cute, and he's trying to be clever. And doesn't he just look? His head looks like a dick. He just looks like a dick. He epitomizes a dick. I'm sorry.
Markets, there are various ways to validate data stored on crypto ledgers called blockchains. And one of these ways is called staking. Investors lock up their tokens in escrow and help validate the next block of data. Some stakers are then rewarded with new tokens. Staking, though, can be complicated and time-consuming. It can take big upfront commitments of tokens. There's also the risk that you won't get new tokens even if you stake. Thus, crypto...
That's not how that works, Gary.
Entrepreneurs started offering what's called staking as a service. No, not like the steakhouse.
He's so funny. He's... Really? I mean, low-hanging fruit, dude. I mean, he's really trying to... Buddy, I'm funny!
Basically, if you
Douchebag.
transfer your tokens to a staking as a service provider, they take control, possibly pooling your tokens with thousands or millions of others while promoting returns.
Yeah. Yeah, that's promoting returns. And there's different kinds of returns, there's different kinds of staking pools, and there is a lot of literature out there to inform you of exactly what it is you're getting into.
But here's the rub. When a company or platform offers you these kinds of returns, whether they call their services lending, earn, rewards, APY, or staking,
This man has absolutely no charisma, talk about bland, like a saltine.
that relationship should come with the protections of the federal securities laws. That means you, the investor, should receive important disclosures. For example, what do they actually do with your tokens? Are they really staking them? Are they lending, borrowing, or trading with them?
There are different kinds of staking pools, and it specifies what is being done with them. So if you add for example, KuCoin, right? I have a lot of experience leverage trading on KuCoin. So if I put $1,000 up and I leverage it, say 10x, okay, so I borrow $10,000 or $9,000. Now I'm paying interest back. The more you borrow, the more interest you're paying, and it is a set fixed amount. I'm paying that interest back no matter what, right? The longer I hold on to that loan, the more interest I am paying back. It's a daily fee, right? Now, that interest that I'm paying goes into that staking pool. So this is just one form of staking, right? So those people that are staking their money, they're getting the interest, and because a lot of people leverage trade, so there's a lot of money flowing in, flowing out. It's essentially a guaranteed ROI, right? And depending how long you lock up your tokens for. Again, there's many different kinds of staking. That's for another video, but that's just an example.
Are they commingling them with their other businesses?
See what he did there? You see what he did there? That's an FTX reference. That is an FTX reference. Way to be on the ball, Gary. Where were you 8 fucking months ago? They just filed a lawsuit for Do Kwon, for Terra Luna. 3 months ago. Where were you, Gary? Where were you? Oh, that's right. You were in back rooms making deals with Sam Bankman-Fried, which, we still haven't spoken about. Has anybody spoken about that with you, Gary? What about those deals? SBF had this wonderful, regulatory framework all dolled up, ready to be introduced, was introduced to Congress to be voted on with your fucking help.
Where do the rewards come from? Are you getting your fair share? Are the underlying crypto protocols genuinely creating value on your investment? Or are they just new tokens that dilute the value of ones you already have? Remember, if you have a stake, it's S-T-E-A-K. If you have a stake meant for 2 and cut it into 3 pieces, it's still the same amount of stake. Unfortunately, because these staking as a service providers generally are not providing proper disclosures, there's currently no reliable way as an investor to know the answers to these important investment questions. Plus,
see that flow? Wow, amazing. I don't write scripts. I don't do anything like that. I'm not reading off of cue cards. Nothing. But, that is just painful.
you sign on the dotted line or accept the terms of service.
Only one thing counts in this life. Get them to sign on the line which is dotted.
You are generally agreeing that placing your tokens with these providers may mean transferring your ownership to them. There's an expression in crypto.
That is and has been a case. Celsius is the quintessential example of that. When you are literally giving them your tokens and locking up, and Celsius went bankrupt. Again, there are different forms of stake. Kraken is a major exchange. It's one of the top exchanges, especially in the United States, based out of the United States. So to go after Kraken, their staking only is just bonkers.
Not your keys, not your crypto. You see, you're basically in a...
Oh. Wow, that's a...
investor in their platform. If it goes under, and we've seen plenty of that recently.
Yeah, way to come in after the fact. Way to come in after everything has happened. Where were you before? Where were you? What job were you doing when all of this was happening? What the fuck?
You end up in line in the bankruptcy court. That's why it's so important that these companies and platforms comply with the securities law. After all, the securities laws, regardless of what you think of stake or staking, they're good for investors. Basically an investor in their platform. If it goes under, and we've seen plenty of that recently, you end up in line in the bankruptcy court. That's why it's so important that these companies and platforms comply with the securities law. After all, the securities laws, regardless of what you think of stake or staking, they're good for investors.
Okay, so I will point out again that there was no way, no forms, no documents, no portal on the SEC website for these exchanges to sign up, Gary. So this is, as Brian Armstrong pointed out, a disingenuous offer. A disingenuous offer. There was no way to register. Do you think, I'm not the sharpest tool in the shed, but I don't claim to be. I think I'm an above average Joe. These people that invested a lot of time, a lot of money, and are pretty intelligent folks, right? Building this exchange, the first publicly traded exchange. It's on the New York Stock Exchange. You can buy shares of Coinbase. Do you think that maybe, just maybe, they tried and they looked and they did their due diligence to cover all their bases? And maybe, just maybe, there was no way to sign up. So this is the epitome of a disingenuous offer. This is the epitome of just coming in after the fact, laying down the law, laying down the hammer. Oh yeah, brother. This is what I'm going to tell you. This is what we need to do. It's all about you, retail investors. Whoo! Boom! bullshit. Bullshit. You lying, slimy motherfucker. You don't care about retail investors. Stop saying it. Stop. It's... Okay. So, okay, let's watch this let's watch this other video that he posted. This is also after the fact.
What is a qualified custodian, and what does it have to do with the securities laws? A qualified
So cute.
custodian. No, not groundskeeper Willie from The Simpsons. I'm talking about a different kind of custodian. One that supports your assets when you work with an investment advisor. Investment advisors advise investors or funds with literally tens of trillions of dollars of assets under management. They advise mutual funds, hedge funds, pension and retirement funds, endowments, or those robo-advisor apps that you might.
Such as, what, BlackRock? Citadel? I mean, who are we talking about here, Gary? The people that we retail investors couldn't want anything less to do with? Is that who you're talking about, Gary? Because fuck no, fuck you, no. But hey, please continue.
Might use. Thus, it's pretty important that when you entrust your assets to an advisor, they don't inappropriately use, lose, or abuse your assets. That's why.
Man, he's just got this flow to him, just boom. Use, lose. I mean, what do you expect with a guy that has a head shaped like a penis? I don't know.
We at the SEC have a custody rule. The rule requires that any advisor who can access your funds must use a qualified custodian to protect your funds.
It's gotta be qualified.
The thing is, we haven't updated our custody rule
since
1933. 2009, just after the financial crisis and major frauds like.
Where were you guys then protecting the American people with all your power? Where were you guys, huh? And you're gonna come in now in this new asset class and just steamroll everything like you know what the hell you're doing when you obviously don't, and you're trying to enforce your own biased bullshit? Come on.
What happened with Bernie Madoff. The next year, though,
30 years strong.
2010,
Go Bernie.
Given these events, Congress gave the SEC greater authority and scope to expand our custody rule to better protect your assets placed with an advisor. Not just your funds or securities, but all of your assets. And using these authorities, earlier today, we put out a new proposal to do what Congress asked and to account for the lessons and new technology from the last 13 years. Under the proposal, a qualified custodian would be subject to independent audits, certain documentation requirements, and yes, to segregate your assets into an account with your name on it.
Yeah, I bet he wants to segregate more than your assets. That was a multi-level joke, and
updated rules would better help protect your and groundskeeper Willie's assets.
What the
with
fuck?
advisors. The rules apply to crypto assets with advisors as well. Thus, that advisor would be required to keep your crypto with a qualified custodian, not on requirements.
Groundskeeper Willie? What the fuck are you talking about, laddie? I don't want anything to do with you, Gensler. We want nothing to do with you. Me and me Scotsman, this is a terrible Scotsman accent. I've been out of practice for a little while, but you penis-shaped son of a bitch, I'll tell you something. We Scotsmen, we don't know what to fucking do with you. Don't fucking compare. Now I'm going into me Irish. Fuck.
carry on.
And yes, to segregate your assets into an account with your name on it. These updated
All right, let's backtrack a little bit.
greater authority.
Just backtrack. I'll shut up.
Custody rule since 2009, just after the financial crisis and major frauds like what happened with Bernie Madoff. The next year, though, in 2010, given these events, Congress gave the SEC greater authority and scope to expand our custody rule to better protect your assets placed with an advisor. Not just your funds or securities, but all of your assets. And using these authorities, earlier today, we put out a new proposal to do what Congress asked and to account for the lessons and new technology from the last 13 years. Under the proposal, a qualified custodian would be subject to independent audits, certain documentation requirements, and yes, to segregate your assets into an account with your name on it. These updated rules would better help protect your and groundskeeper Willie's assets with advisors. The rules apply to crypto assets with advisors as well. Thus, that advisor would be required to keep your crypto with a qualified custodian, not on any crypto trading platform based on how they currently operate, but with a qualified custodian. Crypto companies may claim they can take proper custody of your assets, but when these companies fail, something that we've seen time and again, investors' assets often have disappeared.
We've seen time and again. Now, how many time and agains are we talking about? Are we talking about here, Gary? You know, FTX that you were heavily involved in, and your backroom deals, and your whatever the hell you were doing, your buddy, your mentor's daughter that ran Alameda. What are we talking about here, Gary? Because Luna, yeah, I mean, that was a freaking Ponzi scheme. Where were you guys there? I mean, like, you didn't care. You didn't do anything to prevent that. You didn't do anything to prevent FTX, and you were making deals with the guy. How can we take you seriously? How? Please, somebody give me an answer. How can we take this man with the penis-shaped head seriously? These are the answers we need.
Here to become the property of the failed company. And you as an investor end up stuck in line at the bankruptcy court. So beware, even if a crypto company claims that they custody your assets, it's not the same as qualified custody. Through our proposed rule, investors would get the time-tested protections and, yes, qualified custodians they deserve.
The time-tested. So, do we really want to do, I mean, do we have references to these time-tested, true and brave, and the hill was soggy from days of the brain? What are these tried and true methods, Gary?
So please weigh in on our proposal.
That was a touching video, man. That was good. Yeah, what is a qualified custodian? Still don't know.
What is a qualified custodian? And what does it have to do with the securities law?
Oh no, let's actually just go back over that. Shut up.
Not.
Just don't ever try to make a joke again in your life. Please. Please. Please.
Groundskeeper. Talking about a different kind of investment advisor. Investment advisors advise investors or funds with literally tens of trillions of dollars of assets under management.
So yeah, I wanted to touch back on that. So there is very, very few asset advisors, with literally tens of trillions of dollars of assets under management. So,
they advise mutual funds, hedge funds, pension and retirement funds, endowments, or those robo-advisor apps that you might use. Thus, it's pretty important that when you entrust your assets to an advisor, they don't inappropriately use, lose, or abuse your assets. That's why we at the SEC have a custody rule. The rule requires that any advisor who can access your funds must use a qualified custodian to protect your funds. The thing is, we haven't updated our custody rule since 2009, just after the financial crisis and major frauds like what happened with Bernie Madoff. The next year, though, In 2010, given these events, Congress gave
All right.
the SEC.
Okay. All right. Now, okay, let's talk a little bit further about fractional reserves if you don't know what they are. Because it's kind of important. So let's delve into this fractional reserve real quick, and I'll wrap it up after this. Because I'll just make another video about why stablecoins are not securities. Look up the Howey test, okay? Just look it up. All right. Because, anybody that has a bank account and has any significant amount of money in their bank, they really probably have absolutely no clue that this is a thing. So what is fractional reserve banking? Fractional reserve is a system which only a fraction of the bank deposits are required, where only a fraction of bank deposits are required to be available for withdrawal. Okay, just let me read that again. Where only a fraction of bank deposits are required to be available for withdrawal. Meaning, if you put $10,000 in the bank, only $2,000, I mean, it'll say you have $10,000, but only a fraction of that amount. They're literally playing with the rest of your money. And are they disclosing what they're doing with your money? Are you getting reports on where your money's being used and lent out to? Who's borrowing your money? Any retail investor has never gotten a report about what's going on with their money. So, Gary, what the actual fuck are you talking about when you're talking about staking? It makes no sense. So, let's proceed. Fractional reserves work to expand the economy, blah, 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 free capital, and most economies do. Yeah. Fractional reserve banking describes a system whereby banks can loan out a certain amount of the deposits that they have on their balance sheets. Banks used to be required to keep a certain amount of the cash depositors placed in their accounts of reserve. All depository institutions are paid a specific interest rate in their reserve balance holding to encourage holding reserves. So, okay, let's just, you receive interest as an incentive for keeping money in an account the bank can use to create loans. You receive interest. That is what you're getting interest for. I bet you didn't know that. I didn't know that. Not that I'm a bank. Federal Reserve sets interest rates, and they are based on economic circumstances and how it decides to best meet the dual mandate and maximum employment, blah, 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 blah. All right. It can borrow from other banks and pay them interest as a last resort. The Federal Reserve maintains a service called the discount window, where it lends money to banks at a higher interest rate than they charge between themselves. This encourages banks to seek funds from each other rather than the Fed. Interest is charged between financial institutions on a range set by the Federal Reserve, a board of governors called the Federal Reserve Target Rate Range. The average interest rate banks charge each other is referred to as the effective federal funds rate. Okay, we're learning something new here. Okay, so this is the actual process, the fractional reserve banking process. This is the important thing just to take away. So the fractional reserve banking process creates money that is inserted into the economy. So when you deposit to say $2,000, your bank might lend 10% of it to other customers, along with 10% from 5 other customers' accounts. This creates a loan of $1,000 for the customer needing a loan. Like I said earlier, where do you think when you go to the bank and you get a loan, that money is coming from customer accounts? And when you pay that money back with the interest on top of that, that's where the interest is coming from. He's talking about how staking is. Are you kidding me? But again, we don't know. We, the retail investors, have absolutely no idea what is being done with our money. We don't have a goddamn clue. We don't have a clue. There's more transparency in staking pools. We have more literature. We at least know, okay, my money's being used for leverage trading. It's being borrowed. It's being used for proof of stake, proof of work, all these different things. Absolutely no idea what's going on with your money in the bank. Okay, so I'll continue with this. So it'll look like this. Your balance will still reflect that initial $2,000, and the customers that the bank borrowed from also see their balances remain unchanged. So they're actually lying to you. The money is in fact not there. Your money's not there. So people that feel safe keeping their money in the bank, your money's not actually there, guys. What the fuck? What happens if that bank, oh, well, I get, government bailouts. So, I mean, that's a self-answered question. We've already seen what happens. It's not suspicious and curious. But they don't, they don't want you doing your own thing. How dare you? No, this is the tried and true method. This is the tried and true. Okay? None of that new shit, all right? That is actually better, more efficient, more transparent, and actually, better for retail investors. No, nay, tried and true. Because banks are safe. So you could read this, you and 5 other customers have $2,000 in savings. If the bank can use 90% of its deposits for loans, the available capital is $9,000, 90% of $10,000. The bank borrows 10% from each of the 5 accounts, totaling $1,000. There is still a balance of $2,000 in each account, $10,000 total between the 5 accounts. The bank essentially created $1,000 and lent it to the borrower. You receive interest payments on your $2,000, and the bank receives interest at a higher rate from the borrower to pay your interest and profit from the service. Those fucking Jews. It's okay. I can say that. I'm a tribe member. Don't be offended. But this is the tried and true method. Please tell me, what is the difference between this and staking? Now, obviously, if the bank fails and they go out of business, if they fuck up, they make a boo-boo, the government, as we've seen in the past, will come in and say, here, we'll take care of you because, we can't let you go under and all these people lose their money. Can't have that happen. So this is the tried and true method that Gary Gensler is proposing. It is absolute nonsensical bullshit. The video is long enough already, so I may as well just throw in the stablecoin thing real quick. So yeah, stablecoins are just not a security. Real quick, let's just look real. So to define what a security is. So you can use the Howey test. This is a thing. No, if something is a security or not. We can go into the semantics of whatever. Okay, talking about stablecoins now, right? Stablecoins. This is the Howey test. There is an investment of money. Stablecoin it's not an investment. It's a necessity. You're switching. It's a 1-to-1 ratio. So you're not investing in a stablecoin. So that's 1 to 0. The investment is made into a common enterprise. Nope. The investors expect to make a profit from their investment. No. Okay, we're down at 3-0 because a stablecoin, as I said, is a 1-to-1 ratio. Think of a stablecoin as representative of the dollar. You're not expecting to make money off of a stablecoin. This isn't forex trading. You're not trading stablecoins back and forth. That's not how that works in this market. You have forex for that. That's not what stablecoins are for. And there are different kinds of stablecoins. Any expected profits or returns are due to the actions of a third-party promoter. Again, you're not expecting to get any profits or returns on a stablecoin. You're not. That is not what a stablecoin is. It's not what it's for. It's essentially a segue into buying Bitcoin, buying Ethereum, buying Cardano, Polkadot, VeChain, whatever your fancy is. That is all a stablecoin is, because stablecoins are what is paired with look at an example, stablecoins. So right, USDT. You see ICP, USDT. That's Tether. Tether is a stablecoin. Then we have USD, and there's a handful of other stablecoins. But yeah, Paxos is who the FCC is going after right now because of Binance. They're going after them because of Binance. That's literally the only reason that they're going after them. It's absolute ridiculousness. Tether, which is USDT, is 3. USD coin, USDC. That's another stable coin.
They get the picture.